Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 9th, and we'll see how things look for Wednesday, September 10th. Okay, still leaning more towards the positive side, showing some improvements. We're still above the 20-day moving average in the short term and seeing a little bit of a pickup in positive conviction. But now there's a big variable out there. We have PPI coming out in Wednesday's session. We're going to get CPI later on. And that's kind of what the market's been waiting for. And we'll see if any kind of conviction can actually continue to be built. While at the same time, we're dealing with what is typically negative seasonality. But I've been talking about this for weeks, even months to some degree, and it just doesn't seem to matter right now. So the market is holding up. We're seeing negative divergences with some of our indicators, but the market continues to hold up anyway. So we're looking okay for the time being, but as I said, there's some big variables out there that are going to hit the market, and we'll see if that ends up having some kind of an impact. So right at the open, we had a higher open, not much of a gap, and we got up to R1 at 65.08, so above the 6,500 level. Then we declined after that below the unchanged level, below the daily pivot at 64.96, so we fell under 6,500. But then we were able to find support at 64.83. We rebounded back above the unchanged level, the daily pivot, and we closed just above R1, just up 0.27%. We're seeing just well under percent moves either to the upside or downside. And that's also showing a real lack of conviction currently. And we dropped back to below average with volume. And not a real surprise there. Folks are kind of in wait and see mode as far as what's going to happen because it was a month ago that PPI came out and that caught the markets by surprise. It was much stronger than expected. And after CPI had come out. Now, again, as I've been trying to point out too, we're getting a reverse of that this week. PPI is coming out first and then CPI, where a month ago CPI came out first. And we're still positive on all three time frames. Not showing a lot of strength, but not really seeing all that much weakness either. All right, so the S&P, NASDAQ 100, and the Dow, they all set new all-time highs. And when you've got multiple indexes setting all-time highs at the same time, that's positive in and of itself. Well, now we're seeing a little bit of a pullback with small caps and mid caps. And maybe there was some hope in there that the Fed might come in and do a 0.5% cut. And the small caps and mid caps seem to really like that. They like that the interest rates are probably going to go down, but they kind of wanted more than that. And now we're kind of seeing what we've seen before. A little bit of surge with small caps and mid caps, and then kind of chopping along sideways. And in Tuesday's session, they did underperform, where the mega caps, that's what's keeping the market together right now. And a little bit of improvement here in the short term. We have the Williams percent R that's now back on the list. The Stoch RSI is not there yet. Usually, when we're seeing good momentum in the short term, this list is usually pretty full, but there's still a list nonetheless. Both the CCI charts and the stochastics intermediate term, we declined a little bit with the Chaiken Oscillator, but we're still looking rather extreme there, and the Sean trend meter as well. And we'll see. There's really no ability to change the overall scenario as it applies to the Fed right now until we get more of a read on inflation. The dollar was up, and that could have limited some of the gains in the dollar. Interest rates were also up, but not by very much. We've been really dropping with the 10-year yield. We were at 4.05%. Now we're back up to 4.07%, which just a week or so ago, we were in the 4.2 range. Then sentiment, this is what's been a little bit different. Usually when the market goes up, we're setting all-time highs. We would see this reading up in the 65, 70, 75 area. We're neutral right now. So you got a lot of people that really don't trust what's happening right now. So they're doing more hedging. Now, that could be the negative side, that they're apprehensive about things. The positive side is, wow, if this market really starts to take off to the upside, from a sentiment perspective, there's still more room to run. And we're still positive with the trend, but not trending We're not trending in the short term. We're still seeing a weakening trend in the intermediate term, but the green line is above the red line. So we are positive with the up day. The bias is positive, and I've changed the momentum mixed to positive right now. We're still seeing some, especially in the intermediate term, negative divergences, indicators that should be strong. They're actually looking a little bit weaker. That's why I'm keeping it mixed, but you have to go with price, and that continues to hold up fairly well. We just had the NFIB Small Business Optimism Index coming in at 100.8, up from 100.3 last time. Now there was another report that came out, and I remember highlighting this a year ago, and it was pretty bad news a year ago, but the market didn't really react to it. What they do is they come back and they kind of rework all of the employment numbers here, the preliminary benchmark revision to payroll growth estimates. But you see, this is already old. I mean, here we are in September, and this goes through March 2025. That's kind of why the market doesn't really pay attention to it. And it shows a record overstatement of 911,000 jobs, which is kind of interesting. Here we are coming up to 911. We saw that a year ago. It's like they've been cooking the numbers, and then they come out with this report and say, no, 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 those numbers were way too high. The same thing happened this year when they crunched them in a little different way. This is calculated differently than the employment numbers that we get. And so, but because it's considered to be older news, the market doesn't really take it and run with it, but it confirms expectations for a significant downward adjustment. All right, there. So I don't have a chart of that. It's just the numbers that actually came out. And there wasn't really much else in the way of economic reports. Coming up a little bit here with the small or the business optimism index. And that's a good thing. When people are feeling a little bit better and they're more optimistic, life tends to be better in that regard. Okay, this is our weekly look at a bigger picture overbought, oversold composite. Still getting a pretty high reading at 88.75. We're up in this red area. Usually when we break above 70 or so, that's when we start to get concerned. We've been hanging around up at this area now, but it hasn't led to any kind of a reversal at least yet. So on the other hand, you can take this as positive, meaning that, okay, yeah, we're overbought right now, but the market's still holding up. Then the equity positioning coming down a little bit, but still above zero. No real changes there from the last time we saw this chart. The largest stocks trade 28 times earnings, okay, below 2021. I don't like these date comparisons because the context is different and tech bubble levels. All right. And I point this out in the intermarket analysis video over the weekend where, yeah, the 5 largest stocks, they're expensive, but they've been expensive for a long time. And so we don't use this as a timing mechanism. And where I come out with the PE ratios, whether they're historical or forward looking, is they don't seem to matter until they do. But we don't know when they are going to matter. We're actually showing a little bit more of an increase here with the other stocks that are in the S&P. We're actually coming in above 20 now, where that typically has been residing under the 20 level. Then earnings estimates for 2026, they're the largest for tech stocks, then they've been revised up. And this is where we're seeing the real strength from. That's why I show charts of these stocks. That's why we keep an eye on them, because they account for most of the earnings per share, where here's the S&P itself, and then the rest of the S&P, the other stocks not including the big, really big ones. And speculators are net short across U.S. stock futures. Now, speculators, okay, these are the folks that they're not the smart money. They think they are, but they're not necessarily the smart money, and they are net short. Now, this could actually add fuel if we really start going up. They're short, and if the market likes the PPI report and then eventually the CPI report that'll come out, and we start going to the upside, these folks are going to have to bail on these positions, which means they're going to have to buy, and that could end up really pushing stocks higher. All right, and then gold seems to be doing rather well these days. They've more than doubled over the past 3 years, where this is the spot. This means cash price right now, not the futures contract. I tend to follow the gold ETF and the silver ETF, but it just shows how this has been increasing. There was some profit taking, I believe, in Tuesday's session. And then systematic equity positioning, when the market's really going up, this method tends to work better, and it's showing some improvement, and folks are adding to some money there. PE just showing what we already know. We look at the S&P itself. It's in this kind of blocked out area. Now it's coming in at 23 when this chart was put together. But we still have other sectors that are even more expensive than the broader market itself with discretionary. Now this has been a good performing area. Are there going to be folks coming in and taking some profits at some point? And then tech also 29. Yeah, these are big numbers. This is very overvalued when you compare it to that 10, 15, 20 scale. But we've been seeing charts like this now for years, basically. And then the industrials are also considered expensive. And then we still have staples and communication, which are above 20. So they're still expensive, but less than the broader market. And then we hit 20 and start to go down from there, where we have the financials are still considered to be more fairly priced, and healthcare and energy, which are more defensive. Realizing consensus earnings per share growth for select U.S. equity indices here, we focus mainly on the S&P 500, dropping down a little bit here in 2025, but they're projecting it to go up in 2026, and that's what the market likes, and that justifies higher prices. Then we switch over to a different source where I get this rent prices going up. If you think buying a house is difficult, interest rates have been going up and house prices are through the roof. That's a no pun intended there. Rent prices are going up too, and folks are finding it a lot more difficult to pay rent, let alone buy a house. And what's happening here down on the bottom is apartment construction really calming down, really drastically down from what it was before. And then looking at the benchmarks revisions by sectors, and this goes hand in hand with that report that came out that said we were really down 911,000 job 911 with the revision. Most of that was in leisure and hospitality, professional and business services, and then retail as well. So we're seeing lessening here. Where transports, that's going up a little bit, and utilities are seeing a little bit more there. Need folks to generate the electricity for all the AI stuff. But these are the revisions that are down when you break them out a little bit further. And then investment manager index. Okay, what's your risk appetite? And we're seeing this kind of reflected with the sentiment gauges that we see. Folks are not, they're afraid of things, which could work to the market's favor. And they also anticipate that the market's going to go down. And then what sector do you like? Well, healthcare, that's defensive. Financials, we like that that's improving. And utilities, where the areas that typically are growth, at least according to this chart, those are the areas that are not seeing a lot of love right now. And then the S&P, and then the skew index. Now, this is a little bit different than the skew index that I look at, but it's called skew for ETF tracking, because if you own S&P 500 stocks, what a lot of the time will happen is you will use an ETF instead of options for hedging. So it tracks ETFs and the NASDAQ 100. It's pretty steep right now, while the same measure for ETFs trading the small cap is flat. Okay, signaling that traders see more downside risk for large cap stocks. Not seeing that in our charts. These guys might end up to be right, they might end up to be wrong, but other than this chart, we're really not seeing much evidence of that, at least yet. We've seen a little bit of a shift, but not really much of a move. And then bull markets, this just compares when we hit that low in October 2022, and we've been coming up out of that since. That's pretty much in line with what we've seen historically in the past. All right, so here is the chart. Kind of a sleepy day, had a higher open, actually came down, set some support at S1. That's where we set the low, and then a pretty systematic rise here as we go into the rest of the day. So buy a little bit of the weakness here, buy the dip type of a thing, but not an awful lot of conviction behind the move either. And up a little bit, right as I started to record this, the futures were up slightly, but Europe hasn't even opened as I'm recording this now. And we are improving here. The blue line's above the red line. Growth is outperforming value intraday. We're also generally improving overall with the intraday growth to value ratio for the S&P. That's positive. And so growth was up where value was down, and mid cap seeing getting hit kind of hard here. Growth was down more, but it was down less for the small caps when we just look at the growth to value. So kind of still trailing up and not really improving much with small cap growth to value, We did get back above the 50-day moving average with mid-cap growth to value and improving, but still below the 50-day moving average with S&P growth to value. We want this to go up to be more positive. And we're finally coming out of the rainbow, but the rainbow's been rolling over a little bit here with this growth to value ratio. And a little bit of a tick back, but this is the discretionary to staples ratio, which has been performing a lot better. And that's more positive for the market. And setting a new high here with the large cap growth ETF. And we're not above the moving average yet in the short term, and we're just a little bit above 20. So we're kind of in a positive trend. We'll have to see how the reaction is, if any, to the reports that are coming out here. But we're still positive with the green line above the red line. Also positive in the intermediate term, but still below the moving average. However, we're still above 20 at the same time. And we're back down to below average with volume here overall. And not really seeing much fear in the way of the VIX. Still below the moving averages. The moving averages are going down both with the line chart and bar chart. But this is what seasonally will happen going back to August, but we just haven't seen that play out, at least so far. And also seeing a drop off here below the moving averages with the VIX of the VIX, a little bit of a turn up on a closing basis. And we're back up into the red area now with the skew index. This is a little different than the skew index I talked about a minute ago. This is just another sentiment gauge here, and the market is expecting some kind of a big move when we get up into the red area. And we declined, no, actually went up a little bit, very, very little bit here. A little bit up with this fear gauge, and we were a little bit up with this other fear gauge. So we have an up day, but we're seeing fear coming a little bit in other areas back into the market, which could be some hedging because there's some uncertainty of how the market's going to receive the upcoming inflation data. So we dropped off here, though, with the daily equity put call chart. We're going down with the 5-day chart, and we're going back up with the 10-day chart. Actually, it declined just a little bit, but the bigger context is that this has been going up. Not seeing a lot of confirmation across the board here. Picking up a little bit above the range here with volatility risk premium, but still not really moving all that much. And we actually came down a little bit with the advanced decline line based on price, and we ticked up based on volume. But the bigger picture is that this is still positive. We declined, but we're still above zero with the advanced decline ratio. And see, this is all the choppy stuff going on here. We just go a little bit above, a little bit below, a little bit above, below. Now we're back above with the advanced decline oscillator. Even though we're going down with the 5-day and leveling off with the 10-day, we're still seeing more green than red here overall, meaning that there are more new highs than new lows that are being generated. And a little bit of an improvement here with accumulation distribution, still above the advancing moving average. That's positive, and coming just a little bit above the moving average with the boom indicator. This continues to go up with the Chaiken money flow. We were flat after Monday. Now we're starting to go back up here with the red line after Tuesday. And ticked up a little bit, but we're still below the moving average here with the Chaiken Oscillator. And we're just coming off of this extreme reading that we've been seeing. Positive with the vortex, with the green line above the red line. And you can see here with the NYSE common stock, we declined there. We declined with the S&P. But now with the mid caps and small caps, we're starting to fall back below the moving average. And on an up day, the stocks in the S&P above their 20-period moving averages, declining, but still above 50. I've been trying to point out these negative divergences here. As the S&P has been going up, we've been setting lower highs here. Also seeing a negative divergence with the 50-period moving average study, and it declined. Not really much of a divergence here, just kind of trailing along and looking positive for the most part, even though we declined with the 100 moving average study and declined, and still seeing a series of higher highs here longer term with the 200 moving average study. So just kind of chopping around here enough to set a new high with the S&P. It's not an intraday all-time high, but it was a closing high. And we dropped to below average here on the bottom. A little bit of a decline here, but still above 50 with the 20. We're flat with the 50 and declining a little bit with the 200 moving average study. Above the midpoint and going up with the Stoch RSI. When we're showing more positive conviction, this will get all the way up and turn to this blue area up here, but we're not seeing that yet. Where we are now looking a little more positive here with the Williams percent are just barely above 100 with the CCI 14, and we're above 100 with the CCI 20. In the short term, we're above the moving average and getting extreme with the stochastics, declining, but still extreme with the intermediate short term, turning up, but still below the moving average, and also extreme with the long short term stochastic, and still kind of battling around the midpoint here with the force index, looking a little bit better here with the short term trend. The blue line and the green line are going up. And we just want to watch this 20 period simple and exponential moving average chart. If we see a decline, is this has been providing very good support going all the way back to coming up out of the lows last April. And if we get up below this, we haven't stayed below it for very long. So if there's negative reaction, we'll be watching this level, and still barely in the +2 channel with the standard deviations chart. So actually showing a bit of improvement here with the balance of power, which is positive. Positive with the go, no go. Above the midpoint with the highest high value chart. Now we're on day 90 of the current uptrend with the Landry light. Still positive with proper order, but still seeing a negative divergence here. We're basically going up with the S&P, and this is going down with the TTM squeeze. That's another negative divergence. And just trailing along here with the ease of movement, just barely positive, coming down a little bit, but still positive when we look at the Arun. There's more green up here than there is red, and that gives us a positive reading. And still not really seeing a lot of strength internally in the S&P. We actually went down with the S&P McClellan oscillator, and we're below zero. So we're going down with the summation index based on price and volume. And we're still just slightly positive with the NYSE McClellan oscillator, even though it declined. Very choppy, but trying to go up with the summation index based on price and volume for the NYSE. Now we're back to looking more positive with the Swindle Trading Oscillator. We're advancing based on price and volume where we had been more negative. We were even seeing a little bit of a mixed picture there for a while. And then shorter term, still looking okay here. We're above all these moving averages, and the moving averages are going up, and still going up with the intermediate term trend, the red line and the blue line. Even though we're spending a lot of time below these lines, the lines still continue to advance above all the plotted moving averages. But momentum really trailing off here. Negative divergence going up with the S&P. The PMO has been going down. We're not seeing much weakness here based on price, but we're still seeing more of a deterioration of things based on volume for the S&P itself. Coming down below 50 with the PMOs that are rising, dropping below 50 with the buy signals, and dropping off a little bit with the PMOs above zero. We set an all-time high, and we're seeing internal weakness right now inside of the S&P, but we're positive. When you look at the closing basis here with the Elders Impulse System, positive with the parabolic SAR, still negative with our momentum oscillators, though, below a declining moving average with the slope oscillator, just coming right back up to the moving average with the MACD. So still trailing off in the short, intermediate, and long term. Negative with the Copic curve, and still improving, but not extreme here with the Sean trend meter. And we actually climbed back above 50. The money flow is showing some improvement, so that's turning back to positive. We're also above 50 with the ultimate oscillator. We're above the advancing moving average with unbalanced volume. Positive here with the RSI study, short and intermediate term, but we're still seeing more of a negative divergence, setting lower highs here with both the short and intermediate term indicator. And we're actually turning back to positive now with the bullish percent index. We saw enough of an advance to get back above the moving average and hanging around, but I'm still calling it positive. I don't put moving averages on this one, but since we're above 50 and just not really seeing any weakness, this is also positive. And we are seeing some improvement with the NASDAQ 100 bullish percent index. That has crossed back above 50. And we're still above this R1 pivot point at 64.68. We'll see. We've got to finish out the week to see if we stay above that level. Still at the upper end of this trend channel. That's about when things started to slow down. But we're positive with the Chaiken Ashi, the Kigi chart, the Renko chart, and the three-line break chart. Long term, actually seeing a bit of a decline here with the 150 and 200 moving average study, but it's looking okay longer term. Positive on all time frames with all the different indexes, still negative with the dollar across the board. Bonds, even though they pulled back, are still positive based on price in the short and intermediate term. And now commodities are back to being positive on all three time frames. And then we saw where discretionary took a bit of a hit, industrials, materials, then utilities, that was stronger. Communication, which is a growth area, that was up fairly well. Not much of a change here with tech. An awful lot of green here. Canada, another day, another new all-time high. We got above 21.8 with the NASDAQ, new all-time high with the S&P, the Dow, and again the NASDAQ. And then we saw BPI cross back above 50 after it just got done crossing below 50 with the real estate sector, and gold just seems to be on a tear right now. So you're seeing nothing that big where Google and Meta were up. That helped the market. Those were the mega caps that really helped drive things. Nvidia was up, Microsoft virtually unchanged, Apple was down. Apparently they're having their big conference where they're unveiling the next latest and greatest that are coming out from Apple. It usually happens in the late summer, early fall. And it seems like every time they have this, their stock goes down. I don't understand that. At least I've just noticed that over the last few years. And the Dow, just, yeah, not a real convicted all-time high here, but still looking okay that way. And positive after being neutral with the diamonds and setting an all-time high with the NASDAQ. That's positive there. Positive with the Elder's Impulse system. And we haven't surpassed the intraday highs here, but on a closing basis, the NASDAQ 100 set a new high there. Positive with the Elder's Impulse system. Actually starting to turn positive for the first time since Memorial Day. We're finally seeing this turning back up. Now, we've seen this before, and then it started to taper off again here, but this is showing some hope for right now. And here we are, back into a range with the S&P 600. We're also not as big of a range, but still not really breaking out with the Russell 2000 small caps. Neutral with the Elder's Impulse system for the small caps. A decline here with the mid caps. It's still a fairly good looking recent bar pattern here of higher highs and higher lows. And neutral after being positive with the Elder's Impulse system for the mid caps. Doing okay here with the Wilshire 5000, setting another new all-time high, but not an intraday all-time high. And doing good here with the total US stock ETF. The financial sector still above its 50-day moving average, but not showing much of an improvement when we look at the ratio between the financial sector and the S&P. New all-time high here with the FANG index. This is the really big stocks, and they continue to pretty much hold the market together right now. But we are lagging when we look at the semiconductors, not really breaking out here. We're positive, we're above the moving averages, but you can see kind of a trailing off that's been happening with the Dow Jones Semiconductor Index, and a bit of a trailing off here with the SMH Semiconductor ETF. So Apple was down, and unless we see a big decline here, we're probably going to generate a golden cross to switch that over into an uptrend. Where Amazon was up over 1%, and we're below the 50-day moving average with Microsoft virtually unchanged. Google, that's kind of the shining stock right now. It seems to be breaking out. And Meta was up above its 50-day moving average, and we're still below the 50-day moving average with Nvidia. Where Tesla is still above both moving averages, but this is a downtrend where we see the short-term moving average below the longer-term moving average. And then Netflix is trying to break back above its 50-day moving average and seeing an improvement with the correlation in the short term between US and world stocks. A little bit of a tick up here with the longer term correlation. Oil went back up here, but we're still in the lower end of the 60s and still in a downtrend here with the US dollar index. And we did come back up with the 10-year yield, but this was a really big drop that happened really pretty quickly. We'll see if PPI and then ultimately CPI have much of an impact on this. So maybe it's becoming a bit overbought. We had come up into this above 70 level with the RSI with the 10-year based on price. So maybe some folks are trying to lock in some profits after seeing some pretty good gains over a short period of time. And then seeing a bit of an improvement here with the Qs to S&P. And we came down, but we're still above the advancing moving average with discretionary to the S&P and coming back above the moving average with large cap growth of value. So we're seeing some slight improvements there, but we need to see more follow through with this and some improvement here with the large caps back above the moving average with the mid caps, still below the moving average with the small caps. All right, so we're positive and we're still above overhead resistance right now. That hasn't changed over the last few days. We'll get the weekly mortgage applications index, PPI, that's the biggie. And then wholesale inventories will be coming out as well. And then all these crazy things going on. France is on fire now, and there's all these protests in the UK. There's things in the Middle East. And okay, all right. So, and of course, everything domestically that's happening in the US as well. But None of that seems to really be impacting the market. So then on Thursday, we'll get initial and continuing claims. CPI is going to be coming out, and then we'll get consumer sentiment on Friday. So here, this is kind of the big part of the week that's starting to happen as far as the economic reports. We'll see if it has much of an impact. What's going to be frustrating is if we see mixed reports. One part's strong, one part's weak. Okay, we'll have to see how that works out there. Seasonally, though, when you go back to 2002, September 10th, very positive. And so maybe that has the market going forward as well. But where September tends to be quite weak overall, here we pick out September here. Not a really strong month, but hasn't been showing up so far. And we're kind of still working our way through the first half of September, concerned that the second half of September has typically underperformed. This also shows seasonal weakness that we really have yet to see develop. This also shows historical weak seasonality. So we're still looking more negative though with the S&P McClellan Oscillator and Summation Index. So there's a few stocks that are helping the S&P to go up, but we're not seeing a lot of broad participation currently, and we're still negative with the oscillators that we follow, and that's pretty much it. And we are improving. The Chaiken Oscillator though it's starting to drop below its moving average, even though it ticked back up. But accumulation distribution and Chaiken money flow are looking pretty good there, but getting a bit of a mixed picture. And longer term, we're still looking good with our growth to value and discretionary to staples ratios. We are above zero with the McClellan Oscillator for the NYSE, which means the summation index is positive. And now back on the positive side is the Swinland Trading Oscillator, parabolic SAR is positive, and our bullish percent indexes. Those had been negative for a while, but they are now showing some signs of improvement. And then we have our secondary indicators, the ease of movement, money flow, and ultimate oscillator are positive. The vortex is positive. It's gold because it's a primary indicator. And then the momentum. Been a long time since I've been able to put this over on the positive side. And then the financial sector by itself, but still underperforming the S&P. And then the long-term special K chart, both the daily and weekly chart are positive. And here are the pivot points for Wednesday's session. So our conclusion, positive, above overhead resistance, wondering is it going to hold? Now we're not going to know the answers to that until Friday, unless we see a really big up move and we just break way above it. So we still have to kind of wait and see how that's going to play out. And we are seeing an improvement in the conviction. That's positive right now in the short term. If we start to go down, we'll be watching those 20-period moving averages. And I haven't changed this. There's some strength developing in the intermediate term and also some weakness and also a lot of negative divergences that we've been seeing. But we've been seeing those for quite a while now. And then long term, we still continue to be positive. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.